Hey there, financial explorers, and welcome back to the channel. Today, we're diving deep into a fascinating corner of the market, specifically focusing on a stock that's recently landed on our hard-to-borrow screener with some truly eye-popping numbers. We're talking about CLRO Inc., ticker symbol CLRO. If you've ever wondered what makes a stock hard to short, what cost-to-borrow fees actually mean, and how all this ties into potential short squeeze mechanics, then you're in the right place. We're going to dissect CLRO's situation, understand the risks, and what to watch for. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/stock chart. Let's kick things off with a profile of CLRO Inc., CLRO. This company operates in the technology/communication equipment sector and currently boasts a market capitalization of $17.09 million. While CLRO was incorporated way back in 1983 and is headquartered in Salt Lake City, Utah, it's important to note that the company previously focused on the design, development, and marketing of professional audio conferencing, microphone, and video collaboration solutions, but currently doesn't have significant operations. Now, let's look at the recent price action show chart with price data highlighted because it's been quite a ride. Today, CLRO is down -9.9%. Over the last 5 days, it's seen a decrease of -12.87%. But zoom out to the last 30 days, and you'll see an incredible surge of +101.81%. This tells us CLRO has been highly volatile. And speaking of volatility, let's look at the volume. Today's volume sits at 108,100 shares, which is significantly lower than its 30-day average volume of 6,441,633 shares. This gives us a relative volume of 0x average, indicating today has been exceptionally quiet compared to recent activity. What is cost to borrow and why it matters? So, what does it mean when a stock like CLRO is hard to borrow? When investors want to short a stock, they first need to borrow shares from someone who owns them. They then sell those borrowed shares hoping to buy them back later at a lower price, return them to the lender, and pocket the difference. But borrowing shares isn't free. There's a fee involved, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. The higher the demand to short a particular stock or the fewer shares available to borrow, the higher this fee can climb. When you see CTB fees exceed 100% or even several %, it signals that lenders are charging a premium, making it extremely expensive to maintain a short position. Why the stock is hard to borrow right now. Highlight CTB fee on screen. This brings us directly to why CLRO popped up on our screener. CLRO Inc. is currently displaying an astounding cost to borrow fee of 723.8% annualized. Let this sink in, over 700% just to hold a short position for a year. What's more, this isn't a static number. We've seen incredible CTB momentum with an increase of +599 percentage points over the last 5 trading days alone. This sharp spike suggests a rapidly shrinking supply of shares available for shorting, coupled with persistent demand to short the stock. Currently, there are only about 20,000 shares available to borrow for CLRO against an estimated float of just 0.7 million shares. Our internal composite squeeze score, which factors in CTB levels, momentum, borrow supply, float size, and price action, puts CLRO at a 46.7 out of 100. While not top-tier score, these hard-to-borrow metrics are definitely significant. Squeeze mechanics explained. For those new to the concept, a short squeeze occurs when the price of a heavily shorted stock rapidly increases. This price increase can be triggered by positive news, high buying volume, or simply a lack of available shares to borrow. As the price goes up, short sellers, who profit when the stock price falls, start to face mounting losses on their short positions. To limit these losses, or to avoid further rise in borrow fees like the ones we're seeing with CLRO, short sellers are forced to cover their shorts. Covering a short position means buying back the shares they initially sold. This forced buying creates even more upward price pressure, which in turn can force more short sellers to cover, creating a cascading effect of short squeeze. With CLRO's very low float and the current astronomical CTB, the mechanics for a squeeze are theoretically present due to the tight supply of shares. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction that the stock price will eventually fall, and they are willing to pay a premium to maintain that bet. Dilution risk check. Show SEC filing example. Now let's talk about a critical risk for stocks like CLRO, especially when considering a short squeeze, dilution. Our dilution risk check flagged CLRO because recent SEC filings show a registration statement specifically in S-1, S-3, or 424B within the last 90 days. What does this mean? A registration statement often signals that a company intends to issue and sell new shares to the public. When a company issues new shares, it increases the total number of shares outstanding. This dilutes the value of existing shares because each share now represents a smaller percentage of the company. In the context of a short squeeze, dilution can be a significant obstacle. If a company suddenly floods the market with new shares, it can increase the supply of shares available to borrow and short, or simply absorb any buying pressure that would otherwise drive the price up. This can effectively offset or even negate a short squeeze thesis, even with very high cost to borrow fees like CLROs, by providing short sellers with an exit or new shares to short. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, if you're tracking CLRO, what should you keep an eye on? First, continue monitoring the cost to borrow fee and the number of shares available to borrow. Any further significant decrease in available shares or increase in CTB could intensify pressure on shorts. Second, watch the volume and price action. A sudden spike in sustained buying volume, particularly on a day with positive news, could be a catalyst. Third, and critically, monitor any developments regarding that dilution risk. Will the company proceed with the offering? How many shares will be issued? New filings or announcements could provide clarity. Finally, keep an eye out for any news regarding CLRO Inc.'s operations or strategic direction, as this could fundamentally impact investor sentiment. CLRO Inc. CLRO presents a fascinating case study in the world of hard-to-borrow stocks, with its incredible 723.8% cost to borrow and extremely limited borrowable shares. But as we've discussed, high fees alone don't guarantee a squeeze, and factors like dilution risk from recent SEC filings can significantly impact the outcome. Remember, the market is complex, and understanding these mechanics is key to navigating it. This has been a look at CLRO through the lens of short squeeze potential and risks. If you found this deep dive helpful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments below what other hard-to-borrow stocks you'd like us to cover next. Thanks for watching, and we'll see you in the next video.